The last time we had 4 double-digit S&P 500 years back to back to back to back were the late 90s. And we know how that ended ultimately with the bubble bursting in 2000. So as we set up for potentially what bulls will hope for, a fourth straight double-digit market year in 2026, you have concerns that the market's getting a little frothy here, that this bubble is building. Similarly, though, what you're seeing the last couple quarters, as big tech came out with their earnings results, they posted incredible numbers, and the market wasn't having it. You saw stock prices get slashed despite wonderful earnings results for the most part, slightly dimmed outlooks maybe on profit margins, et cetera, in the case of Broadcom as an example, and the market was unforgiving. I think you're going to see a repeat of that pattern where we have unrealistic expectations as we head into earnings seasons. Stocks get a little hammered in the high growth, the big tech sector, and then those stocks recover as the quarter continues. Ultimately, we know AI is not going away. The long-term thesis is tremendous, but a little bit of a pause so that valuations and earnings and can kind of catch up to one another would not be a bad thing in 2026.
This is interesting that you said unrealistic expectations, and you're basically referring to the idea that whether it's investors or it's retail investors or VCs or whoever, they are thinking about the idea of AI trade, and they're saying, well, we want our returns now in 2026 or 27 at the earliest. And you're suggesting, I think, that is an unrealistic expectation. What I want to understand is, why is it an unrealistic expectation? For how long will this momentum is the moat phrase going to be used to continue to fund this space, perhaps extend this so-called bubble, without that question being asked, hey, give me my return?
Well, I think you've gotten tremendous returns to this point. The pace of those returns is likely to diminish and is perhaps unsustainable. So what we're advocating for is having some dry powder, having some cash on the sidelines, diversifying your portfolio. You still want to let your winners win. Technology and AI in particular is both the putter and the driver in the market right now for short-term returns.
I'm sorry to interrupt, but Chris, that's a tough one, because the moment you take some money out or you pause this particular momentum, you lose the battle in AI.
As an individual investor, I still want exposure, but I want to lessen my exposure, and I would advocate investors consider that. And then when you do see that volatility, when you do see those pullbacks, when you do see prices and valuations that are a little more reasonable within the quarterly cycle, it's an opportunity to add there.
Yeah, I just want to also get a sense from you if you're not entirely excited about AI, not because it's not great, but because you think you should diversify, and we understand that. Which other sectors are you looking at? And talk to me in the context of inflation, because this market is concerned about inflation.
Sure. And so from an inflation standpoint, we really like consumer staples here. The idea being that if you look at how they behave, their correlation towards technology growth and AI, there's a little bit of an inverse correlation there. We also think, if you look at the typical U.S. investor's portfolio, it's extremely underweight international and emerging markets. And 2025 was kind of the year of, hey, wake up, take a look. There are other markets outside of the U.S. that investors should be paying attention to. We love Europe here, we love Japan here, and we love international in general, not as instead of U.S., but in conjunction with U.S., because the opportunities are broadening around the globe from an investor standpoint.
You said international and emerging markets, as I understand, but you mentioned Japan and EU and international in general. But within the international space, which particular markets are you most excited about?
Within international, we like developed Europe, we like Japan, and when emerging markets, basically the way that we look at it as find me an alternative now, right, to my traditional relationships, my traditional supply chain arrangements, my traditional trading partners. So Vietnam, very attractive here. India, very attractive here, as the short list within emerging markets.
You've seen the tensions between the U.S. and Venezuela. How do you see oil prices impacting consumer sentiment, the market in general in the U.S.?
Well, it's interesting, given all of these conflicts that we're seeing around the world, that crude is priced at where it is, as you pointed out, around $57 a barrel now. And for many firms, you're getting very close to the cost of production. For some of the bigger, larger, higher quality names, think Exxon, et cetera, they're able to produce at a much lower cost per barrel. So if you're going to be playing oil and energy, we recommend really going for quality firms here. The biggest, the best, the dividend payers get paid to wait.